Hi, I'm Bob, the Mortgage Coach Mitchell, and thanks for checking this video out. This is number 4 or 5 on the topic of if you should buy a house. In the other videos, we talked about several considerations such as job stability, affordability, commitment to the area, and a few other things that you really should think about before you make the decision to buy a home. Today, we're going to talk about cash needed to buy a house. So let's get you into a home. Anyway, there are 3 basic categories of costs that you're going to need to cover in order to successfully buy a house. The first is your down payment. Everybody's heard of that. Now, your down payment can range from as little as $0 to paying cash for the home and not even messing with the mortgage. If you could do it, there's an argument to be made. There's also an argument against that too. But anyway, generally speaking, the more that you put down on the home purchase, the easier it is to get approved for the mortgage, and that anytime you put less than 20% down, that you're going to have to provide an insurance policy that's going to protect the lender in the event that you fail to make your payments. So, depending on the program that you choose to utilize in order to buy your house, your insurance premium will have different names. For example, on a conventional mortgage, that's Fannie Mae and Freddie Mac, the insurance policy is called private mortgage insurance. On an FHA mortgage, the policy is called a mortgage insurance premium. Now, USDA doesn't even call it mortgage insurance, but rather a guarantee fee. It's the same thing. It's mortgage insurance. Mortgage insurance is one of those topics that deserves its own video, and I plan on covering the topic in greater detail in an upcoming one. But anyway, for now, suffice it to say that if you're going to put less than 20% down of the purchase, 20% of the purchase price down as a down payment, that you'll have to include these premiums in your calculations on the funds needed to close and on your monthly payment. The 2 biggest determinants on how much your down payment is going to be is how much you have available and how expensive the mortgage insurance premium is going to be. So if your funds are limited, you might want to choose a program that doesn't require a down payment, such as USDA or VA. There's also some non-conforming products, but I'll talk about those later. There are also other programs such as FHA. That's a low down payment of 3.5%. Conventional can go down as low as 3%. Anyway, closing costs for those items, where we're going to talk about the closing costs. So if you didn't buy the home, you wouldn't have to pay for things such as an appraisal, title insurance, underwriting fees, etc. We'll be covering closing costs in greater details in an upcoming video. You're going to hear that a lot. Anyway, the last category of costs that you're going to incur are called prepaids. Prepaids are costs that you incur in owning the house, but that you have to prepay on the day of closing. An example of this is your homeowner's insurance policy, another topic for a future video. At closing, you'll need to pay for your first year's insurance premium, which will cover you for the next 12 months. Plus, the lender will establish an escrow account that will hold 2 months worth of the monthly premiums as a cushion. In addition to those 2 months, you're also going to have to make an additional payment to cover the pre-period from when you close until you make your first payment. So on a purchase, you'll need to prepay 15 months worth of the homeowner's insurance premiums. In addition to the homeowner's insurance escrow, the lender will also establish an escrow for your taxes as well. This escrow account requires a 2-month cushion plus a deposit to cover the period between closing and when you make your first payment. So usually 3 months worth of the taxes. Lastly, some mortgage insurance premiums are also escrowed. Some are paid on a monthly basis, some are escrowed ahead of time. Anyway, these escrow accounts are where the lender would take the money in order to make the insurance renewal, pay the taxes, and any mortgage insurance premiums that may be due. Now, there is one last category, and this is a very important one. I call it wiggle room. Okay, we need wiggle room money. That is monies that you can put into, that you're going to have to put into the transaction in order to wiggle your way through to closing. These costs incur any earnest money deposit that is negotiated into the purchase agreement, any due diligence deposit that is required by the purchase agreement, plus the cost of the appraisal, and if you choose to have one done, the cost of a home inspection. Again, we're going to go into greater detail on these costs in a later video. For now, just remember that even if you're going to do a zero down mortgage with the seller paying all of your closing costs and prepaids, which is called a seller concession, which will again in a future video. Anyway, that you'll still have to cover these costs up front and be reimbursed at closing. So you're not, and they can add up. You got an appraisal, it would be $600, $700, $800, $900,000. You have the due diligence, can be, $500, can be $1,000. Anyway, there are going to be 3 categories of costs that you're going to incur: the closing costs, the prepaids, and the down payment, plus any wiggle room money. that you're going to need. In our next video, we're going to see where you might be able to secure these funds to cover these costs. Now, as always, if you're already ready to move forward with the purchase and need to talk on an immediate basis, please don't hesitate to reach out to me in the comments or through my website, bobthemortgagecoach.com. If you're finding these videos helpful, please consider liking, subscribing, and sharing them. You hear that on all these things, but it really does help the channel to grow. Thanks for your time and consideration. I look forward to interacting with you in the future. Now, let's get you into a home.